Good morning and welcome to Money Plant, a Doordarshan MCXSX joint initiative to spread financial awareness among peers. In our previous episode of Personal Finance series, we learned how investor can start investing in and what precautions they need to take while being invested. Well, a large portion of investors of Indian investor community invest depending upon what their peers follow by listening to various market rumors, tips, source of money for investment, intraday and react panicky to good and bad news. We'll discuss this issue in today's episode. Let's discuss more about behavioral finances. We are now joined by Mr. Parag, Chairman, Parikh Financial Advisory Services Limited, and Dr. Narayan Rao, Associate Professor, SJM School of Management, IIT Mumbai. Welcome to Money Plant. Let me start with Paragji first. Paragji, tell us what is the behavioral finances is about?
Normally we all are under the impression that markets are efficient and people make rational decisions to maximize profits. But since last 20 years there has been a new school of thought which is laying a lot of importance on how people make decisions. Now, we as human beings have a mind as well as a heart, and normally we are supposed to make decisions by our rational mind, but many a times we make decisions out of our heart because we are human beings, and when we make those decisions out of our heart, they may not be necessarily in our financial interest, and that's why we have many smart people making big money mistakes. That's what behavioral finance is all about.
You just said it, we make a big money mistake also. Why it's necessary to understand investors the emotional biases and in making the investment decisions? How does it impact?
It's important to make this, make one understand one's own biases as well as understand the biases of others. Because when you know others' biases, it helps you to benefit from them. And when you know your own bias, it helps you not to make those mistakes. And these behavioral biases come in very different forms, but just understanding the stock markets by only looking at what the company is doing and what analysts are saying is not going to get you anywhere, because most of the time the analysts and all, they are talking what all others are talking, and that's why in a bull market you find that every time they think everyone is talking about buying stocks, and in a bear market everyone starts about selling stocks. Actually, if you have to be a good investor, you have to do opposite of what others are doing. In bad markets, when the markets stock prices are down, that's the time you should be buying, not when everyone is buying. And the unique thing about investors is they find a stock more risky when nobody is buying and when the prices are low, and they find it less risky when everyone is buying and when the prices are high. I think that is the first anomaly which all investors should understand, that you make money when you buy low and sell high, not when you buy high and sell low.
That's the most important thing, and one should take a note of it. Dr. Rao, is there any traditional way of investing, and how do you compare traditional way of investing with the behavioral finances?
See, the traditional investment theory assumes, as Parikh said, efficient market hypothesis, existence of efficient market hypothesis, and this efficient market hypothesis has three pillars, or we can say three blocks. One is rationality, second one is independent deviation from the rationality, and third one is arbitrage process. So what we mean by rationality is that investor will be always considering risk-return factors before investing, nothing else, right? And if at all they are deviating from this rationality, the deviation will be independent, not dependent kind of thing, which brings back the equilibrium prices in the marketplace. And despite that one, if there is a kind of mispricing in the marketplace, maybe underpricing, overpricing, then we have these animals called arbitrageurs who will enter the market, buy the stocks which are underpriced, sell the stocks which are overpriced, and try to bring back the equilibrium prices in the marketplace. And as long as these three blocks are strong enough in the marketplace, then we can say traditional theories will be efficient or effective in the investment decision making. But the history shows that they are not strong enough, and that's where the the new approach of behavioral finance has emerged based on the weakness of these three blocks of efficient market hypothesis. One weakness is rationality. These people believe that people are not always rational. So they are irrational and they are dependently irrational. So that's the one foundation for the behavioral finance, which is also called the cognitive psychology or cognitive biases. And the second foundation is limitation of the arbitrage. Arbitragers will not be always coming to the rescue of the marketplace for bringing back the equilibrium prices, because sometimes they may also incur the losses in the process of bringing back the equilibrium price in the marketplace. So the difference is that if you have these assumptions of the efficient market valid, then traditional investment theories will be good for the investment. Otherwise, you have to go for the behavioral approach for investments.
Doctor, how to use effectively this behavioral finance? Is there enough awareness among the investors now?
Yeah, let me give one example how we can apply this behavioral finance concept in the investments. If you see that late 90s IT bubble in the US market, where the IT companies were overvalued, and the reason for that one was one of the cognitive bias, which is called representativeness. So what we mean by representativeness is that you will be analyzing the performance of the company based on the very recent performance, maybe 1 year back, 2 years back kind of thing. And as of those days, these IT companies, internet companies were not having a very long track record of the performance. At the most, maybe having 3 years performance. And you take the 3 years performance and extrapolate that the performance for the future, which means if they are grown by 30%, 40%, you believe that that growth continue for the next few years. And if you do that, you will come out with a highly overvalued kind of valuation. And just assume that you are aware of this cognitive bias like representativeness, probably you would not have paid that much of high valuation for the stock, which would have avoided that kind of IT bubble. So these are the some concepts which you can use in a positive way for making your investment more effective. So that's the difference between the traditional theories and the behavioral finance. It will be useful. Sometimes it may be helpful to maximize the profits, sometimes to avoid the losses. So both the ways, I think it will play important role.
More about the behavioral finances. Yeah. We are taking a short break now. Do stay with us.
हमें अपने सिद्धांतों से समझौता नहीं करना चाहिए।
मैं इस सरकार की रीढ़ को पहचान चुका हूँ।
चौधरी जैसे लोगों के सामने अगर आप झुकते रहे तो आपको हमेशा झुकते रहना पड़ेगा।
इसको करता है कि पत्रकारों को बुलाकर समर्थन वापसी की घोषणा कर ही डालूं।
ये मत समझिए कि सरकार के गिरने से आप यहाँ से बरी हो जाएंगे।
आपने मेहरा साहब की बात मान ली तो आज ये बच्चे जिंदा।
मैं जूली सिंह, तुम्हारी भाभी।
ने अपने बाप का खून किया है, मेरे पति को मार डाला है।
Welcome back. You're watching Money Plant. Parag ji, you had a very rich experience about the investing also. It is observed that most of the times investor might not find right price, when to sell, how to sell and what to sell. And then they buy when they need to sell and vice versa. What are the reasons for that? And how to enter in a proper time? Because sometimes you observe that the investors are entering late into the market.
See, first is what is investing? The definition of investing is buying a good business at a reasonable value, expecting a reasonable rate of return. So now the investors which you are talking about, I would say they are really not investors, because investors don't buy every day and sell every day. Those are known as speculators, traders or punters. So investors have to understand that every day you don't get investment opportunities. And most of these investors, when the markets are bullish, every day they want to do something in the market. That's why they lose money. They don't lose money because they are investing. And if we really look at the returns from investment over a period of last 30 years, equities have returned on an average 18 to 19% per annum to the investors. And still sometimes investors cry stock markets are dangerous, stock markets are not the right place to be. Investors, they say that we have lost money, we lost money in the technology boom, we lost money in the power boom, in the infrastructure boom. Now, why did they lose money? Isn't it a paradox that equity as an investment class has done exceedingly well? Investors have lost money. Now, investors have lost money because they did what investment prohibits them to do. So it's very important that you cannot be every day buying because you read in the newspaper that this company has got this, or if you are watching in front of your TV and then you find one analyst saying that I bought this so you buy this. That's the reason that all these media channels, only in a bull market they have all analysts talking to them and all. In a bear market, nobody is there. That's why you find IPOs always coming in bull markets, because these investors are willing to pay stupid prices for the stocks of the companies which the management is giving. So investors have to understand that today, if you have patience, if you are a long-term investor, definitely this market has so many of these people who are only speculating, trading. They will give you the opportunities.
You made a very valuable point कि investing it doesn't mean intraday trading or the daily trading, because
Not
it
at
has
all.
to offer a good investment opportunity. Dr. Rao, why investor prefer this fixed income rather than equity? Because equity market is very dynamic and aggressive, though, as Parag ji said also. It has given good returns over the years. Why the investor prefer for this fixed income?
See, in the marketplace, we have three kinds of investors. We can classify them in three categories based on their risk-bearing capacity. One is called the risk-averse investors, which means they cannot bear more risk, and typically these kind of investors will be preferring the investment in the fixed income securities. And the second class is risk-neutral investors, which means they have the balance of equities and the fixed income securities. And the third category is the risk-taker investor, which means they are willing to have huge exposure for the equities class, and probably they sometimes also go for the gambling, which means borrowing others' money and investing in the equity market. So generally, this is the kind of type of investor which determines where they should be investing. That's one factor. The second factor is also the kind of equity market trend. Typically, in the rising market, everyone wants to invest in the equity market. In the falling market, most of them want to go back to the debt market or the fixed income securities. And the third factor is the kind of liquidity. Okay, if the debt market is having high liquidity, probably that may be motivating for investors to have invest in the debt kind of securities. So these are the factors which have impact on the preference for particular kind of instrument. But typically in the Indian context, since it is a growing market, most of them want to prefer to go for the equity market because there is a growth. In the emerging market, we have the growth, so they want to capture the growth. Even though you are a risk-averse investor, but you want to try with the equity market.
Of course, India is a growing economy, growing story.
That's right.
Dr. Rao, sometimes it happens the census crashes down by 300, 400 points. What is the psychology of these investors?
No, that crash definitely will have impact on their psychology, because typically, typical investor behavior is that you will be overreacting for the bad news as well as the good news. So if the media says that the market has gone by 2,000 points in 1 week's time, 1 month's time, that motivates them to go for the investments. Then again, media says that within 3 weeks or within 1 week it has lost hugely, it motivates them to come back of the investments. It has impact on the trading in the trading volume and also the entering and exiting the market. It has strong impact.
So investor has to grab the information also very selectively. He should not believe everything what is being said.
That's true.
We are taking a short break now. Do stay with us.
आज है एयरटेल क्रेजी के तृतीय के दूसरे अंश का फाइनल।
देखिए हर गुरुवार रात 9:30 बजे एयरटेल क्रेजी किया रे सिर्फ DD1 पर।
I'm so thrilled.
The stage is ready. The date is set. The countdown has begun. Watch the 19th Commonwealth Games from the 3rd to the 14th of October 2010. Live and exclusive only on Doordarshan.
Welcome back. You are watching Money Plan. Parag ji, what is mental accounting and how investors can avoid them in their financial planning? What are the symptoms?
Well, mental accounting, this thing goes with mental heuristics. Now, mental accounting is that to the same value of money is fungible, but this thing we give different values to it depending upon how it has come to us. This thing, the effort taken to earn that money. Like you get 100 rupees, this thing by way of your salary, you're going to treat it very nicely and take care of it. But if you 100 rupees you get in a lottery, then you are bound to spend it away. Now that is what mental, that we as human beings keep money which is fungible, which has the same value, we keep in different accounts in our mind. That's why some people, they would go in for margin trading, but at the same time keep their investments in a fixed deposit, paying them 6% interest, and in margin trading they will be paying about 18 to 20% interest. So mental accounting is all about having different types of mental accounts in your mind, this thing for the same type of money. Now a corollary to this is mental heuristics, that when we make decisions, the brain takes shortcuts in making decisions. It does not make decisions by processing all the information, and it is because of this that you have certain biases. Now these biases come in the form of an availability heuristic, is that you make decision based on readily available information. Like you watch a TV, you see an analyst, he says okay you buy this, and you just buy that stock without trying to see whether that information is correct or not. Then, as Professor Narayan mentioned, representative heuristics. They think if Tata Steel comes out with fantastic results, you start buying every steel company, even the laggards, expecting that they will also come out with good results. Then you have the herd mentality. Oh, my friend bought, he bought, so then we all start buying. And this herd mentality is so dangerous that whenever you are in a market, you find that you are always only fool in the market because everyone is making money. But you have to realize that everyone will only talk about their profits, they will not talk about losses. So you have to be careful that you are not the only fool in the market, everyone is a fool. So if you want to be wise, you have to understand that investment opportunities don't come every day, and you have to buy the thing when others are not buying.
So as an important informed investor, what one should do in such type of situation when there is enough information about particular thing, how to take a proper decision?
First is, I would say that you don't take decision based on what you read in the newspapers or what you see on your TV channels and all, because those channels are there to give you information. And they are doing their duty on giving you information, but you are trying to consider that they are giving you tips in the market and you want to play in the market. I think that is the first thing you should do. Secondly is, investors need to know that you have to go to a professional fund manager or a professional advisor, and who understands what you want, and you have to understand that what he is capable of delivering to you. And just getting into the stock market because everyone is buying is not the right way. In short, you have to be greedy when others are fearful, and you have to be fearful when others are greedy. If investors are able to have such such disciplines, then I am sure that you will make good money in the markets.
Dr. What is the endowment effect and what are the symptoms and how to avoid that in financial planning?
See, endowment effect is is a kind of hypothesis which says that people in general tend to place high value for the objects which they own than the objects which they do not own. And if you apply this concept in the equity stock market, what it means is generally investors will be having a kind of high valuation for the stocks which they are owning and looking for a kind of higher price relation before selling them. And the symptom is that you go on logging on for that stock for a long time. You don't liquidate when you get a kind of information that it is time to sell. And probably to avoid this kind of phenomena is that the investor should be open for revaluation as and when they receive the new information, new policy or the new regulations. For example, as of now, let's suppose there is some valuation for the retail stocks. Now the government is talking about opening this retail sector for the MNCs. Yeah. Then the valuation will change. So you cannot say that this is the kind of value which I want. You will not get it.
So what is the recent research in behavioral finances? Is there any papers? And how do you compare Indian investor with the investor in the developed economies?
Yeah, the research which at least we have undertaken is, one is about testing of the price movement strategies, other is about the filter strategy. Price movement strategy is about buying the winner stock, which means the stock which have been on the rising in the recent past, and the selling of the loser, which means the stocks which have seen the fall in the recent past. And filter strategy talks about selling a stock when the price comes down by certain percentage, let's say 2% or more compared to the previous high, and buying the stock when the price goes by 2% or more compared to the previous low. And both these studies shows that there is not significant abnormality out of these strategies. Then we have also done a study on the impact of the dividend increase announcements and the bonus announcements, and the finding is that market takes as a kind of positive impact or the positive signal for the future prospects of the return. Now if you talk about the Western kind of research which is in the recent times is done, there are few studies which talk about some kind of support for the behavioral finance approach. The conclusion is investor follow one by one heuristic behavior for the portfolio construction, which means if you have 100 rupees, you will be equally distributing among the available asset class without talking about the risk return kind of parity. And the second conclusion is 45% of the variation in the stock market participation, asset allocation and the portfolio's risk choices is explained by the genetic kind of components. And the third conclusion is superstition induced behavior affects investment decision. And this study was particularly about the eclipses, solar eclipse, lunar eclipse, and what's the impact of those eclipses on the stock market return. The finding is that they are taking serious, not only the Asian market, even the Western market also taking serious. So, to my knowledge, there's not much difference between the Indian investor or the investor in the developed markets. They are human beings. They are one and same. Not much difference between them in their behavior.
Yeah. Paragji, the investors come from different ACCs also. The professions are different. How to avoid these emotional biases while making a proper decision, investment decision? How to access the information? Because he's not from the same. It's not a homogeneous. He may be a different profession, maybe business class, traders. So how to take the decision and how to avoid this emotional bias?
No,
what recommendation you will give?
That would depend upon individual to individual, but as I mentioned earlier also, that when people are looking at investing, they have to look at a long-term point of view. Now see, they buy, they're saying insurance policies, life insurance policies, do they every day check whether they're dying or not? But then why, when you have a portfolio where every day you want to look at the stock market whether things are going up or down? I think that discipline is required. Secondly, you have to understand that the law of the farm, you cannot sow something today and reap tomorrow. A seed has to go through different seasons before it turns into a fully grown tree. So is the case with investments. And I think our country, India, offers very good investment opportunities. Only thing, the investors, if they think long term, if they think in being a part of the growth story, then they have to be invested for the long term, and definitely they will see the results. Because equities over a period of time, if they have given you 18 to 20% return compounding, it's phenomenal return.
It's phenomenal. Yeah.
Only thing, investors themselves, they don't have to make the blunders. Like they sell when everyone is selling. When everyone is selling, you have to be buying. When everyone is buying, you have to be selling, because that time the prices are wrong.
Dr. Rao, your take on that?
Yeah, same is the kind of, if the investor doesn't have expertise, what we suggest is let them go through the, mutual fund kind of investments rather than direct investment. That's a good thing for the small investors who doesn't have expertise, or the kind of people who have small amounts, who cannot afford to access the information for analysis kind of thing. So best way is let them go through the mutual fund. That's the kind of international trend. In the American market, we have the more mutual funds than the listed stocks there. So that's what should be coming for India in the years to come.
Paragji, one last question to you. As he said about the mutual funds, everyone knows that India is a happening economy, growing economy, and everyone wants to be a part of it. To investor, what advice you will give? To the investors, what sectors, or they should go for the IPO, they should watch for IPOs, whether it's giving a good opportunity now?
See, I'll tell you very honestly, for the investors, they have to go through a professional, because this market is very complex, a lot of things, so you go to the right professional, that would be the right way. And we have seen the mutual fund industry in our country just started growing since last about 15 years, but I foresee the way the regulators are going on, they will allow more and more asset management companies, more and more mutual funds to enter in the market, which will make it highly competitive, and then you will see very good returns from the mutual fund industry. As Professor Narayan says, that well, the institutionalization of the markets is happening, and more mutual funds will come, and people will have more and more avenues. There are very good amount of professionals in the market, in the form of financial planners, plus investment advisory. Individuals are good. You take the right individuals and go by their advice, and sky is the limit for the growth for any investment opportunity.
So have a long-term perspective, go to the professionals.
Yes, that's the most important thing.
And
you have to be
proper advice to be in the market. Professor Paragji, thanks a lot for joining us on Money Plant.
Thank you.
Well, that's it we have for today's episode. Thanks for watching. Please send your valuable suggestions to Money Plant, Doordarshan Kendra, Varli, Mumbai 400030. Have a nice weekend. Namaskar.